Hey folks, welcome back to the channel. In last week's video, I introduced an option strategy for Alphabet that you can put in before they announce earnings. It was basically selling a short put and buying a long call spread. So basically after earnings, if the stock goes up, you make money. If it stays flat, you make money. And if it goes down, as long as it doesn't go below 92, you would still make money. That was the last weekly candle over here. And what happened? Well, after earnings, the stock price went up. So if you did a strategy like that, then congratulations, you made some money. Your 92 short put would have expired and the call spread should have made you some money. So I'm going to take a look at my portfolio right there. I put this trade in last week. I paid $37 for it. Now it's worth $48. And you can hold on to this until basically the following week, February 17th, and see where it goes. But I'm most likely just going to close this upcoming week, like on Monday. The idea is to not miss out on the gains if Alphabet does go up after earnings, which is what happened, even though I don't think it should have, which is the point of today's video, where I'm going to talk about how the market is currently delusional, and it just doesn't really make sense to me why it's doing what it's doing. So I want to show why it's important to be really vigilant right now and be careful about going into next week. So it all kind of started on Wednesday with the Federal Reserve increasing rates by 0.25. That part was not surprising. The market expected that. And Powell said they wanted to keep interest rates higher for longer. During the press conference, a reporter asked him how many times he thinks he's going to continue raising it, and Powell hasn't changed his mind over the last few months. He still thinks the terminal rate will be above 5%, but the stock market still doesn't believe him and is pricing in like a maximum of 4.8%, which is pretty much where we're at right now. So here's a 5-minute chart for what happened on Wednesday. It was pretty much flat through most of the day, and then after the Fed rate announcement and Powell started to talk, there was a slight dip, and then the market went higher, which didn't make a lot of sense to me because even though Powell wasn't particularly hawkish during his speech, he wasn't that dovish either. He still said his main priority is to lower inflation. So I was actually expecting the stock market to dump the next day on Thursday because that's what happened around previous FOMC meetings. And after the market closed on Wednesday, Meta announced earnings. Wall Street was expecting $2.26 per share, but the actual EPS came in at $1.76, which was quite a disappointment. So the company is now, based on that quarter, half as profitable as it was last year because the earnings were basically slashed by 52%. And taking a look at the press release, we can compare the most recent quarter to the previous year's quarter. Sales had actually shrunk a little bit, and net income was reduced more than half because they hired a lot, but obviously there wasn't a lot of top line growth at the company. Now, even though revenue was down from last year, they did beat expectations a little bit. Instead of 31 billion, they made 32 billion. So that's a positive sign, but overall, the company doesn't seem to be growing and it missed earnings by quite a lot. If I take the difference of what Wall Street expected and what they actually made, which is 50 cents, that is a 22% miss. Now, the previous quarter, they also had a miss, about 14%, so that one wasn't as bad. But the stock fell 25% in that October earnings announcement. So today, if you just looked at the numbers themselves and looked at the press release, you would probably expect the stock to react in a negative way. But instead, this is what we got. Boom. A 25% jump in a single day. And at the top of the day, it was actually like a 30% move. This green bar here is Thursday, and then it closed the week on Friday, this one here. So since that last quarter, the stock is up from $100 to $186. So that's an 86% price appreciation just in a single quarter. And their numbers haven't even improved. Not only did it fill this previous gap fairly quickly, but now it's basically left all of this trading action in the dust. Now, I am a shareholder of Meta. I have 150 shares. So it's actually one of my larger holdings. But I'm thinking of trimming my position a bit and maybe sell 50 shares because it doesn't make a lot of sense to me why the stock would react this way given its current financial situation. And then on Thursday, we had the anticipated job numbers. It was expected that employers hired 187,000, but the actual number came out to be 517. So that is a huge surprise to the upside. The unemployment rate has now fallen to the lowest point since over 50 years, which means pretty much if anybody wanted to get a job, then they can find one. And this, of course, puts upward pressure on wages, which is not good for inflation. All through 2022, the stock market did not like it when employment data came in strong and there were more jobs created than expected, because that would give the Federal Reserve more reason to continue hiking rates. So with such a big surprise to the upside, you would expect that a lot of investors would be nervous that this could potentially create more inflation later this year. And if the economy is doing better than expected, then there's just less reason for the Federal Reserve to cut interest rates. But what did the stock market do on Thursday? It went higher. And for part of the day, it even climbed above 417.5. And that's a crucial benchmark because that represents a 20% increase from the lows of the bear market back in October. So from here to 417.5 is about 20%. And a 20% increase from the bottom officially means the bear market is over and we are now inside a new bull market. But this is a weird reaction because in the past, strong payroll numbers always put pressure on the stock market to go down, not up, at least throughout the last year. And finally, after the market closed on Thursday, we've had Amazon, Alphabet, and Apple all coming out with earnings, and they all disappointed. And these three tech giants are important because they are all in the top 5 holdings of the S&P 500, with Apple being the largest holding by size. So out of 500 different names, Apple, Amazon, and Alphabet are very important. So when they move, it does move the entire index by quite a lot. Apple had one of the most disappointing quarters. Its sales dropped 5% over the same time last year, which represented the first time they had a revenue decline in many years. And if we look at the actual numbers, earnings missed. They made 1.88, but Wall Street was expecting 1.94. Revenue also missed. So that earnings miss and revenue miss are both pretty rare for this company. So you would probably expect the stock to go down, but look what happened on Friday. It started the day down, but by the end of the day, it was up 2.4%. Amazon and Alphabet also posted earnings with disappointing results, but unlike Apple, Amazon and Google shares actually fell. So at the end of the day, SPY closed down just 1%. You would have expected it to drop a lot more, especially given the weaker than expected earnings report of some of the biggest tech companies and the major holdings in the S&P 500. So the overall trend is still going up, but as I've explained, this doesn't really make sense why the market would still be continuing to go higher. So in terms of where we would expect the market to be next week, if I draw a bullish channel that goes up like this blue dotted line represents the end of next week, which is Friday. We have pretty strong momentum going up. So there is a chance that the stock market could go up higher next week. However, there is this green line over here that I put in at 428. And that's where the stock was hard rejected back in August of last year. So that's going to represent some pretty strong resistance. And despite the week overall looking strong, the only thing that might stop it from going higher is that on Friday, at least we had some weakness. So if I draw a line connecting the top of the wick on Thursday and Friday together, it's going to make a bearish line like that. And I can highlight the bottom of the bull channel with this one. We have support going up on the bottom and it's finding resistance up here on the top. At some point around here, it's got to decide whether it's going to break to the upside or downside. Whichever line it breaks first is likely going to continue going in that direction. So if it breaks through the bottom line first, then it might retest and continue going lower. If it goes through the top first, it's most likely going to try and retest and then continue heading higher. So this blue line over here is Monday, and then this is Tuesday. By Tuesday, we should be able to tell whether if it's going up or down, and then by Wednesday, we should really know. So that's something I'm going to be paying attention to. And even if it goes up, there's not much room for it to continue increasing because right up here is the 428 resistance line from August. So unless there's some really good news, either we are going to go down next week or we're going to go up first and then probably go down the week after. Now, the only thing I can think of why the market went up, even though there's not a lot of news that would support that kind of movement, is that a lot of the buying has been done by retail investors. So this article came out a couple of days ago. Retail trading just hit an all-time high. Basically, retail investors like you and I make up about 10 to 15% of the stock market's volume during a typical day. However, over the last couple of weeks, retail investors made up about 23% of the volume, which is even higher than in 2020 and 2021, when meme stock first became really popular. And what do retail investors like to buy? Well, mostly tech stocks. Like other than GameStop, AMC, and other smaller companies, retail investors really like to buy, the Teslas, the Apples, Microsoft, Amazon, so all of the large holdings of the S&P 500. And because 23% of retail investors have been buying, that's like a quarter of the volume. So when you have that much pressure pushing those stock upwards, and those just happens to represent some of the highest weightings of the S&P 500, you'll probably see the stock market going up, even though there's not a lot of reasons why it should. So short term, I don't know. We'll have to see which line it breaks first. But in the medium term, like over the next month, I wouldn't be surprised if we see a retracement and another down leg back to at least the 400 level on the SPY. but more likely this level right here around 387. So don't let the fear of missing out tempt you into chasing the stock market higher. I would not think about buying more stocks in the market right now. As long as the SPY remains below this line right here, the 428 line, I remain medium-term bearish. But definitely by next week, we'll have a better idea of where the market wants to go. Anyway, thanks a lot for watching. I hope your investments are doing well. I mean, if you're a buy and hold investor, you should have done pretty well over the last month. Let's see where we go from here. And until next time.